Meeting is now streaming live on YouTube.
Hello, world.
Okay, it looks like we're live.
Super. Thank you, Mary. Well, I'll call to order. This is the Board of Park Commissioners Investment Committee. And for the record, this is Jim Getz. I'm the chair. We also have with us Craig Sherman, CFO of the parks, Steve Pullman and John Nyer, both members of our committee. And we have guests and we have Patricia from the Park Board as well. And we have our first agenda item today is a presentation by US Bank. So Ken, I think we're just going to let you take over from here and start your presentation for us.
I appreciate that, Jim. I believe Craig was kind enough to send everybody the meeting materials in case we couldn't share it. So if you have those materials in front of you, we will start with that. And the materials begin on page 5.
Got it.
This is basically just a quarterly recap. It's been quite a while since we actually met in person. So, to just kind of take a step back, obviously the entire calendar year since, I guess early March has really been dominated by COVID-19, and we've seen some dramatic market fluctuations. And as this addresses the third quarter, you can see that it's really been kind of a tale of two cities, where we've seen the best quarterly growth, economic growth since World War II, but we're still seeing activity below year ago levels. So, we've definitely seen or started to see the start of a V-shaped recovery post-COVID, but most recently, we've started to see that activity plateau. So, one of the biggest agenda items you hear in the news right now is the potential for fiscal stimulus and the battle between the White House and the House right now to come up with a stimulus bill, and then whether or not the Senate will play along. I just heard that the Senate did not pass their proposed $500 billion bill this afternoon. So the Speaker of the House and the administration continue to try to to hammer out some sort of resolution, and that along with news that we hear regarding the potential for a vaccine or therapeutics, as well as, the next 2 weeks leading up to the election, are all going to be things that we think will definitely cause some volatility in the market going forward. For the quarter, equity markets finished quite a bit higher. September, we did see a little bit of a fall off. And then, October so far has been pretty strong as well, and we'll look at that. And then, obviously, we're at historically low interest rates as a result of the Fed stimulus policy. They basically set Fed funds rate at 0. And over the last quarter, as the economy improved, we did see riskier high-yield bonds outperform investment grade in the third quarter, as well as corporate bonds outperforming treasuries, which continue to be at historically low interest rates. And then you'll see that last bullet point there just talks about, REITs perform strongly along with much of the real asset sector. Commodities definitely showed a strong quarter. Gold has had an extremely strong year, and energy continues to lag year to date. As you might recall, there was a period there towards the end of the first quarter where they were actually giving away oil. And so, the energy markets really declined significantly at the beginning of the year, but have started to recover. Any questions there?
Ken, let me just, I want to welcome Commissioner Flynn on the call. And Kevin, we just got started, and Craig had shared with us the presentation, and Ken was on I think he was on page 5 of his presentation.
Thanks, Jim.
Welcome. One of the biggest questions we get asked, and I'm sure, you hear as well, is when are we going to reopen? So if you look at page 6, broadly reopening is thought that we're really not going to see it until we have a vaccine, and that's really with the inoculation of at least 25 million people distributed throughout the United States. So here are some market probabilities of when we will see that, and it's certainly more distant than I think any of us expected when this all began back in March. I can tell you from U.S. Bank's point of view, we originally thought we would be back in the office by the middle of the summer, and then it got pushed to September. And now we don't have official reopening date, but it doesn't sound like it's likely to be until the summer of next year. And this shows you the probability. So right now there's about a 50% probability that we'll see 25 million people vaccinated for the virus sometime between the 21st of January and the 31st of May. And then a 30% probability that we don't see that until sometime between June 1st and September 30th. So obviously news around the virus and vaccines are something that have been driving the markets. We had, I think it was last week, I'm starting to lose track of time, where there was a therapeutic that got put on hold, and then a vaccine that got put on hold because of some testing, and you saw the markets react to that. And so as we continue to see developments in that area, I think that will play a big role in the markets going forward. If you look at page 7, this just really shows you yes, sir.
I have a question with regards to the reopening. Has this been adjusted? I know it's still, you have to wait till the final approval phase. Has this been adjusted with the announcement by Pfizer this past week?
It is not. This, you'll see on the bottom footnote, this was as of October 6th.
Did that have any, do you know if this has been reran with that knowledge? So those, if not aware, Pfizer, before the final approval phase, indicated they're going to produce 100 million vaccinations by the end of December 2020, and they're going to produce 1.2 billion in 2021.
Yes. Yeah, this has not been adjusted. I've not seen a rerun. I'm sure we will. I'm not sure when I will get that, but certainly that is definitely positive news. And when we get that, I can certainly share that with the committee if it's of interest.
I'm actually part of the COVID study with Pfizer, and I think they have been producing all along. The announcement that they came out with last week was that they would be going for early approval in late November, but that was pending continued results. I'm in phase 3, so it's pending results. But I think already built into this, Craig, I know Johnson & Johnson's also already producing millions of samples of their vaccine, but it's not approved yet. So I think there's a lot of hope. But when you look at what this graph is showing us, it's not only that it's an approved vaccine, but 25 million people will have been vaccinated. So I think this has got that timeline built into it, if you want my opinion. But let's hope it's sooner.
Yeah, that's what I'm hoping. I was like, it'd be great if it was a little sooner, but
I'm
there's
still
a lot of
here.
people out there that need it.
Yeah, I volunteered to take part in one of the studies through UC, but they didn't choose me. So
Don't feel bad. They didn't select me either.
You got to be an old man like me to get into those studies, I guess.
If you look at page 7, that just really just shows you a global case growth. And so you can see, really for the most part, starting around mid-July, we did start to see cases plateau. But then, towards the middle of September, we did start to see them climb. The two biggest areas globally where there were spikes were, I think India was seeing around 80,000 cases a day. And then Brazil, I think, was up around 25,000 cases a day. And those were really globally the two most recent hot spots. And then now, most recently, we're starting to see, Europe start to see cases again. So I know there was a lot of news just the last couple of nights around Germany and France and Spain starting to see additional cases. If you look at page 8, you can just see the case growth by region through October 6th, and just kind of gives you a sense of globally the different areas and how the virus has behaved. So you can see, where the U.S. in the dark blue kind of had our, the initial spike on the East Coast around the middle to late March. And then things plateaued, and then, towards the summer, as the economy started to open up, we saw a second wave, and then that declined. And then as schools started to open up around the beginning of September, we started to see, cases start to increase a little bit there. Total foreign developed, you can see where they really plateaued, but then have steadily been increasing since about the beginning of August. So it's just kind of interesting, I think, to see globally the different paths. You can see, where Asia broadly really steadily climbed, and then had a pretty sharp decline starting in the beginning of September. And all of that has really resulted in some significant market volatility. And so if you look at page 9, you can see the wide range of outcomes over the last 12 months that we've seen in terms of the S&P 500, where the market hit an all-time high February 19th. Then it sold off dramatically. It was the quickest move from a bull market to a bear market, where we were down 34%. At the end of March, and then we've recovered strongly. You can see where, in September it sold off a little bit, and started to improve. And as of, today we're sitting at 3,448 right now, up about 15 basis points on the day. So even since this was published, October 6th, you can see the market has continued to increase. Any questions? Page 10 and 11 are really just some interesting leading economic indicators that we're watching, and I like to share because I think it's interesting to see the effects that the virus has had on the economy and where we are in terms of the reopening process. So on page 10, you can see that top line there is TSA travelers year over year. You can see that basically traveling was down almost 100% towards the end of March there as the virus emerged here in the U.S. And then we have started to see it very subtly start to improve, but we're still only, we're still down about 80% of where we were, a year ago. So you can see approximately 590,000 travelers versus 2 million last year. That middle one just shows you open table reservations. Essentially, nobody was dining out from the middle of March to about the beginning of May. And then as the economies, around the nation have improved, you can see those reservations, starting to increase. And you can see the fits and starts as certain areas of the country, have had to pare back in dining, in restaurant dining. And then the bottom shows you same store sales, and and surprisingly, throughout this whole thing, even with the unemployment rate that we saw initially, the consumer's been pretty resilient so far this year, and same-store sales year over year are pretty flat. So I think that is, one of the things that has been driving this recovery that we've seen in the stock market since the end of March. Any questions there? And page 11 just shows you, New York City, its reopening trajectory. Looking at turnstile data for the Metropolitan Transit Authority, so you can see how sharply that dropped off. But then it has been steadily increasing since then. So we certainly keep an eye on this to give us a sense of what, around the country we're seeing. Page 12 just shows you that despite some sizable drawdowns, in 21 out of 30 years, you can have a significant decline in the market, still end the year up. So you can see for 2020, we were down 34% at one point. As of October 6th, we were up 6%, and the market is continued to increase. And our estimate right now for the year is to end at 2,850. So about 400 points higher than we are right now. I'm sorry, 3,960. I'm sorry, 3,960 for the year. So about 500 points higher. And we get there 24 times earnings of $165. Page 13 just shows you the wide divergence in equity asset class performance, and we'll talk a little bit more about this as we look at your portfolio. But you can see that light blue line is the NASDAQ. This market has really been driven pretty narrowly, and tech has been the biggest outperformer. To give you a sense of that between this page and the next, if you look at the top 6 stocks, which is actually 5 companies, often referred to as FANG plus Microsoft, with Netflix thrown in, which is actually 21 in terms of size in the S&P 500. Those FANG stocks plus Microsoft have returned 7.35% through the end of September. The S&P through the end of September is up 5.57%. So the rest of the S&P as a group was down 1.78%. So if you look at the number of companies in the S&P 500 that were up 20% or more, you're talking about 141 versus about 90 that were up 20% or more. So pretty narrow, leadership, and the NASDAQ has been the biggest driver of that, and you'll see how that actually played into your portfolio. The bottom line there, the biggest lagger in terms of equity markets year to date has been EFA, and then the Russell 2000 really struggled, obviously, because of the decline we saw, which was a risk off, but had a really good recent stretch. And you can see that in that dark red there towards the bottom that really kind of spiked since the middle of September. Any questions there? Page 14 just shows you a couple of the sectors, as I mentioned. You can see information technology and healthcare have been, two strong performers. Financials and energy have been 2 of the biggest laggers. I mentioned in my opening comments, the decline we saw in energy. And if you look at page 15, you can see the index performance results. And we came off of a really strong 2019, and as we talk about performance, I'll talk about this a little bit more, but we came into 2019 and we really expected the economy to continue to get stronger, and we actually went to an overweight U.S. equities and emerging markets in January, and then right after we did that is when we saw the initial emergence of the virus in China, and because of China's weighting in the emerging markets, we took off that overweight, but we still maintained it for domestically. And then after the virus emerged as rampant as it did here in the U.S., then we had to go to a neutral position there. But that was one of the tactical changes that we did make, and we'll talk a little bit further. But you can see how strong 2019 was. And then year to date, really, U.S. equities are leading it. The next strongest being investment grade, and then U.S. listed real estate and foreign listed real estate and commodities, the three biggest laggers. We have no exposure in your portfolio to either foreign listed real estate or commodities. We do have some U.S. listed real estate. And any questions there? Page 16 just puts some numbers behind those bar charts because some people are visual and some people look at the numbers. And so you can see 2019, the performance of the S&P 500 was up 31.5%. For the third quarter, the S&P returned 8.9%, which gets us to that 5.6% year to date. Emerging or developed international, rather, EFA was up 22.7% last year. It's still down 6.7% year to date. Was up 4.9% in the fourth quarter. In emerging markets, because of the strength that China showed in the third quarter, was up 9.7%, almost flat for the year. And it was up 18.9% last year. The aggregate bond index is up 6.8% year to date, relatively flat for Q3, and that's simply because interest rates drop so precipitously, and as interest rates decline, bond prices go up. And then you can see commodities, mainly because of oil, down year to date. Oil year to date down 58.3%. And then the U.S. REIT index down 21.4% year to date, both relatively flat in the third quarter. And then cash is now basically yielding zero. So any questions there? Okay, if you turn to page 17 in the book, this will just show you that we're maintaining our optimism for the rest of the year. And the reasons behind that is we've got benign inflation, low interest rates. We've had supportive monetary policy. Initially, in the beginning of the year, we had supportive fiscal policy, and we may hopefully get some more here before the end of the year. And then, obviously, medical progress towards virus therapy and cure, and then secular growth trends among information technology and e-commerce that has really pulled forward, a lot of activity in those two areas. What's really interesting is that last bullet point right now, and one of the things that really puts a floor under equity markets right now is dividend income. Is, for the S&P 500, nearly 75% of the companies are offering dividend yields higher than the 10-year Treasury. And 60% yield better than the 30-year Treasury. So, for people that are looking for income, they're increasingly being forced into the equity markets to receive that. The table on the left just shows you really the breakdown by sector performance year to date. And you can see consumer discretionary was really strong, as was information technology, where year to date, real estate, utilities, financials, and energy have been the biggest laggers. So it's really the haves and the have-nots in terms of sector performance, as I mentioned, being pretty narrowly led. Any questions?
We are still here,
Page
Ken.
8.
so-
No, I just want to make sure if people have questions, I want to make sure I address them. Page 18 talks about fixed income. You can see on the bottom left there how dramatically the yield curve dropped from last year to the end of September. Little move over the quarter, and then since the end of the quarter, we have actually seen the yield curve steepen just slightly, but not significant enough. The bottom right table just really shows you, based on the indexes, where those returns were. And year to date, you can see Treasuries had the best return, again, because interest rates dropped and there was such a flight to quality early in the year. And then, they basically plateaued since over the third quarter. You can see it was a little bit of a risk on in the third quarter, with high yield being the strongest performer over the quarter, followed by investment grade corporates and investment grade municipal bonds. Page 19 really just shows you real assets. Gold continued higher in the third quarter, while other real assets like real estate were mostly flat. For those of you who may follow Bitcoin, it's interesting. Somebody pointed out to me the other day that, with gold's strength as a flight to safety over the last year, Bitcoin has also increasingly gotten some acceptance around being an alternative currency. So it's taken a slightly different path, but over the last year, it's basically posted the almost identical returns to gold over the past year. So,
Ken,
page 20. Yes, sir. Mhm.
long term, because of COVID, do we see the REIT market not being successful as companies realize they don't have to have as much space under lease? People work from home, et cetera.
I definitely think there's going to be some challenges in that market. Absolutely. One of the changes we did make to your portfolio broadly is I did remove the double line fixed income fund, because they are primarily in the mortgage-backed market, for that very reason, because I just think there is some uncertainty around that. I think, as companies realize that their employees have been as productive, if not more productive, working from home, if they can save those real estate expenses, I certainly think they're willing to. But what is also interesting is, in terms of mortgage delinquencies, those have actually started to improve quite a bit. So I think rents and mortgage expense by companies will certainly show challenge for that market, but defaults will not. So does that answer your question?
Multifamily REITs and industrial and other REIT sectors, the initial REITs were more focused around office, but I think the other REIT sectors could cushion that as well. So if office is off, 20-30%, if there's a balance of REITs, probably that reduces, that averages that down, I would guess. I would hope, at least.
Right, absolutely. If you look at page 20, this is just something that we always keep an eye on to get a sense of what is going on broadly. Your portfolio is really a mix of both active and passive investments, active mutual fund managers as well as indexes. And so the lower the number here, the fewer active managers that are outperforming their benchmark, or the harder it is for an active manager to have outperformed their benchmark. And so on a 10-year basis, for example, if you look at U.S. large cap blend, you'll see over the last 10 years, only 8% of active managers outperformed the S&P 500 index. where over the last quarter, if you look international, active managers really did have a chance to outperform. And so we do keep an eye on this to see where the trends are. And you know, one of the reasons I think you see that underperformance by active managers in large cap space is, again, what I mentioned earlier, where it's really a pretty narrowly led rally. So, you know, all of the managers have to either be in the same names or they underperform. Any questions so far? That's kind of a recap of where we've been and some of our thoughts around where we're going. I've broken the book out, since this is the first time we've met, as all of the portfolios combined as an aggregate, and then we can look at any of the individual portfolios if you want. For the most part, I can tell you all 4 portfolios are structured identically, with the exception of the one Fleischmann account that we inherited in 2019 that holds some individual bonds. I'll point those out, and it just did not make sense to sell those bonds because the coupons are so high. And my understanding from our previous meetings was that the park board can take the income from the portfolios, so income was really important, and actually more important than actually taking the capital gain. So we've maintained those bonds because of the coupon rate. And if that has changed, please let me know. But that is really the only difference between any of the portfolios broadly.
Yeah, I think you're good with that, Ken. No change from our perspective on that.
Okay. So page 21 shows you the aggregate of all 4 accounts. You can see the portfolio value at the end of September was $6,138,676. Net realized capital gains over the course of the year minus $126,586. The projected annual income on the portfolio is $114,555 with a current yield of 1.87%. The equities represent roughly 70% of the portfolio, 27.75% fixed income, and then cash 1.9%. Down along the bottom, you can see your portfolio against your specific blended benchmark. You can see your benchmark doesn't have any allocation to cash, but we do keep some cash on hand, and that's taken from investment grade. And then currently, the only tactical deviation we've made from your benchmark is we are slightly underweight developed market equity, and then overweight large cap U.S., and then within large cap U.S., we definitely have right now a growth bias. As I mentioned earlier, when we actually started the year, we were underweight fixed income, overweight equity. So we were overweight both large cap U.S. and emerging markets within your international exposure. So we had to reverse course on that. Unfortunately, that put us a little behind the 8 ball in terms of your benchmark right out of the gate for the year, and then we've been working hard to catch up. Page 22 and 23 just show you the individual holdings. The biggest takeaway from this page here, I want to point out, is the net expense ratio of the funds that we hold. You'll see the all-in net expense ratio on a weighted average is 22 basis points. I think when we did the analysis for Craig at the end of June for the fiscal year, it was 21 basis points. And under investment grade, you can see those 3 individual bonds that we hold. Xilinx at 3%, AutoZone 2.5% coupon, State Street 3.7, and Fifth Third at 4.3. So I've not sold those. I was going to continue to hold them unless there's some credit event that would necessitate that, simply because of the high income. A couple things to point out that you'll see when we get to the performance report is that we did make a couple changes over the course of the year. We switched out of the iShares Russell 2000 in favor of that small cap active manager, you see there Columbia, or the American Century rather, small cap value fund. I mentioned earlier that we sold the DoubleLine fund, and then in the preferred stock, we sold an iShares ETF, index ETF, and went to an active manager in preferred stock. And then the other change that we made was we switched the Columbia Dividend large cap fund. We basically just switched. We kept the exact same fund. We switched the share class that we held. We got approval for a different share class that lowered the internal expense ratio on that. So that's one thing that we always do, is we do keep an eye on the individual funds that we have, and if a lower expense ratio share class does become available that you're eligible for, we will make that switch. If you look at page 24, you can really see the individual performance of the fund as it relates to their peer group. And so year to date, you can see total portfolio returns, gross of fees, 2.87%. Total portfolio return net of fees, 2.67, against the Park Board's custom benchmark of 2.51%. So, third quarter, we saw some pretty strong performance, 6.03 net of fees versus 5.38%. You can see total equity performance was 2.21%. And large cap, combined, the funds returned 9.27%, and the S&P 500 was up 8.93%. Year to date, our large cap up 6.45 versus 5.57. You can see from the blank spaces out where that Columbia dividend income, we switched the share class, and then you can also see we added that Invesco QQQ mid-year for a growth bias, and that has really performed strong, up 12.01% for the quarter. Any questions there? Year-to-date mid-cap, you can see down minus 0.77% versus the mid-cap index down 2.35%. Stevens mid-cap growth was the outperformer there. Again, that growth bias, it was up 8.26 versus the mid-cap index that was up 13.92. It gave up a little bit of that you'll see in September, but still an extremely strong performer. And that really illustrates the difference between growth and value over the course of the year, where the mid-cap growth index was up 13.92% versus the Russell mid-cap index value index down 12.84%. So growth significantly outperforming value, and we've definitely had a growth bias to benefit from that. Year to date, small cap, we were down 1.48%. Again, the growth bias helped, where the Russell 2000 index was down 8.69%. And so, Columbia small cap growth, you can see up almost 27% for year to date. And then developed foreign, year to date, the portfolio, developed foreign down 5.69%, again, versus the EFA index down 7.09%. Total fixed income up 4.18%. You can see the corporate bonds that we hold year to date up 1.96%. Bloomberg Barclays Intermediate up 5.61%. Our investment grade mutual funds up 4.37%. Again, trailing right now on a year-to-date basis a little bit from the aggregate bond index. We did hold DoubleLine. We sold that. That was really one of the underperformers that we had, and we reallocated that between the Baird aggregate and the PGIM total return. And then you can see where the principal preferred, that is where we made the switch from the ETF to the active manager there. And that is the aggregates performance broadly. Any questions there?
Ken, I don't know if you're going to go over this now or later, but as you look at this, are there significant changes that you're going to recommend going forward, or are you going to play this out as we speak?
I don't have any changes right now that I foresee. Obviously, we're certainly keeping an eye. As a firm, as I've mentioned, we have the growth bias. We're certainly keeping an eye on things, and if I had to foresee a change at all in the foreseeable future, it might be a switch from a growth to a value bias if we started to see the market turn there. But we've gotten no indication yet that's something that we're going to do, and I don't see us right now making a significant change. Broadly, we're equal weight or at our benchmarks, fixed income versus equity, and I don't foresee that changing anytime in the near future. But certainly, we would make those changes if they were warranted, and you'd see those reflected in the portfolio. So.
Yeah, with the volatility that we have now, it's obviously not the time to be the champion and think you know where the market's going. So I have no problem with the approach that you're talking about as far as maintaining our established game plan, so to speak.
Any other questions? Craig, I don't know if you had a chance or emailed the email that I sent you right before the meeting, but one of the things I was gonna mention, just to give you a sense of where the portfolios as a whole have gone year to date. I wished I'd actually included it in the book, but I didn't. To give you a sense, we started January combined at 6,077,338. Combined, you've taken withdrawals from the portfolio of 104,655. We've earned income so far this year of 68,194, and then we've seen gains of 100,035. So about 168,000 in income and gains versus withdrawals of 104,655. And so at the end of September, the portfolio ended up 6,149,14. So at the end of September, certainly income and gains have covered the year's distributions. Any questions? I'll leave it up to the committee. I can certainly talk about the individual portfolios if you want, and we can look at each individual portfolio's returns, or I can let you go about the rest of your business. It's up to you. As I mentioned, all of the portfolios, for the most part, are structured identical, with the exception of that Fleischman account that holds those individual bonds.
Yeah, Ken, I don't think we need to delve into each one of them individually. As we look at some of your charts here, they're pretty well stacked up, comparable. So I don't think there's a need to go over in detail. I don't know if there's any specific questions anybody's got on performance or assets being held or anything for Ken at the moment. I've got a couple other questions for him, but does anybody else, Steve or John or Kevin, any specifics?
I think it makes sense.
Yeah, hit everything I was looking to. I had a couple of specific questions which were specifically addressed, so I get no credit for doing homework.
We'll note that you did that, John. Ken, one thing that we're looking at in all of our funds is tax treatment and tax classification for our different trusts. And I'm not asking for an answer off the top of your head today, but if you could provide to Craig for each of our individual funds, so for Drabner, Fleischman, Geyer, what is the tax status of each? For example, I assume they're all 501c3 entities, but if you could clarify for us if those are deemed private foundations or charitable entities, can you let us know that?
I will certainly work with Marty to do that. Marty, do you know off the top of your head? I am not a tax person, but I want to say that they are considered charitable because I know that there's specific tax rules that deem how much you have to take out each year, and if you don't, then the IRS takes what you didn't, and you can get penalized. But I think we'll have to reach out to our tax department and find out exactly the rules behind that.
Yeah.
Yeah, I agree, Ken. That's what we'll need to do. We'll need to go to our tax area and find out exactly what they're seeing, in these custody accounts, and we'll have to come back.
That's great, Marty. What if we could, because we're discussing this with our other managers as well, but I know that each trust is considered a separate, I think has a separate tax identification number, all of that. If you could provide Craig just a summary for each one of these funds, what's its tax ID number? Is it considered 501c3, which I'm sure they all are, and whether it's classified as a private foundation or a what's the other one, Craig? It's
Public charity.
public.
Yeah,
Thank you,
public charity.
Steve. Public
And
charity.
Jim, I do have that information, and definitely we're going to be following up with the investment managers around that, because later in the agenda, I was going to bring up what's been identified as the EINs for each of the trusts, and some do have their independent EINs and some do not. They are a city EIN. So
Okay, so you've already got the information from US Bank on this?
as far as EINs, then part of the next steps is I was introducing it, informing you all about what the EINs are, and then for next steps, seeing, okay, well, now we know that not all of them are 501c3s, that some are 501c3s, some are assigned to the city's EIN, so they're probably just charitable contributions.
Okay, so
But what should they be?
I think I would like Ken and Marty, if you could just identify for those if they are considered private foundation or public charities. Because as you mentioned, Ken, that is correct. We're looking at, are we actually filing tax returns for each of these, or is there a 990 PF being performed for them? So if you could look into that, that'd be great, and give Craig the information.
Absolutely.
Ken, US Bank is certainly acting like these are public charities, not private foundations so far, because we haven't been notified of any of those required minimum distributions. We certainly haven't been notified that we've got a tax issue. So perhaps the research is done, and perhaps you'll uncover something. But we'll see what Marty finds. But you're certainly have been treating these as if they were 501c3 public charities.
And Ken and Marty, there's no right or wrong answer. So we're just trying to clean things up from our standpoint.
No, I understand. I know that a couple years ago, I did see copies of letters on the Drabner and the Fleischman account that we had the longest. that did notify the park board of required minimum distributions that had to come out. And I don't know anything about whether or not those same letters were sent for the two newest. So.
Perfect, thank you. Anybody else have anything for our friends from US Bank at this point in time? Hearing nothing, I want to thank you. Craig, you don't have anything either for them?
No, I do not.
Super. Well, Ken and Marty, thank you very much for the presentation. It's been a difficult market, and I just want to thank you guys for managing it so that we didn't have to do it. So thank you. And if we see anything else as we do further homework on this, we'll let you know. But appreciate your presentation.
Is there any? Are we providing enough market commentary? Do you want to see additional market commentary? I know I've sent some white papers out. I don't know if everybody gets copies, but I think Jim, you do, and Craig does, and Steve does. I don't know, John or Kevin, if you want those as well. Are you getting enough market material? Do you want more or less? Have we been responsive to your questions?
You have been responsive, and Ken, we do try and share that data that comes in. So, we all recognize that it's an extremely strange year. So I'm hoping that we don't have to learn from this for the future, but we appreciate the information that you provided, and it's plenty.
Okay, thank you.
Great.
Marty, do you have anything else?
Thank you, Ken.
No, unless you have any other questions for me or anything I can do, I just appreciate including me today, and hope everyone has a good evening.
Thank you so much.
Thank you, gentlemen.
Ken and Marty.
Thank you.
Well done.
Thank
Okay,
you.
well, thank you. Bye now. We'll continue
Take
on
care.
with our meeting here then. And the next item that we had on our agenda was approving of the minutes for August 26. Does anybody have any corrections or changes or input on those? If not, I'll
So
entertain
moved.
Second.
Second.
Thanks, John. So Steve and John, approval of the minutes. All those in favor? Any abstains? Let me know.
Aye.
Okay, thank you. We'll mark those as approved. Craig, we're going to turn this now over to you, let you go through and point out what you'd like for us to take a look at here.
Okay, next on the meeting agenda, we're going to review the performance report. Received the information on Monday from the last investor. So if you go through the performance report, I do want to highlight two corrections that I will need to do due to a formula because of the Geyer Fund and Fleshman Fund now running to a year to date and a full year. I will need to update the formula there. So the total US Bank for year to date should be reflected at 2.67, and then the 1 year should be at 8.72. Additionally, part of the information I provided that was sent out again was the Ball and Gainer. If you notice, their performance on their current year to date was at 0.43, and their benchmark was set at 6.05. So the explanation was sent out. Still interesting there that what's causing that, as well as I'm still pending the 1 year information from them. So once I obtain that, this will be updated for the third quarter. I don't know why that was left out, but it was.
It was interesting. I think I heard Fifth Third say, US Bank say today that people are moving into dividend stock. So I'm hoping that perhaps we'll see a little bit of a recovery here at the end of the year in that sector. Obviously, the 3 months looks pretty good, so I assume that's in keeping with their indication as well, that that is an improving market.
And our one do want to look at as well as PNC, they continue to be our, especially with the Betman count, lagging its performance. If you look at that, you're looking at for the 3 month, they're at 5.06% with the benchmark 5.5, not just off 44 basis points, but looking at the current year to date. And they're off at 0.13, benchmark 4.33. Then you look at 1 year to date, 5.20 with a benchmark of 10.45. And then their 3 year, they're at 5.58 and at 7.55 for a benchmark.
I'd like to get your thoughts. Obviously, we were going to have an initial discussion with Kay about this prior to COVID hitting, and we sort of said, let's not make waves at the moment. But what do you guys think? Is it time that we sit down with Kay and say, hey, we want to share something with you?
Jim, I kind of like the that approach, that kind of I want to share something with you. Here's simply share what our performance experience has been and see what yields from that presentation of information. If nothing comes from that, then I think we have decisions to make, but I think there's enough tenure in history there that I'd be open to explaining. I'd be open to hearing. I'm not sure any explanation is going to, because I mean, the results are mathematical. This happens in Excel, not Word, but still, I guess I'd be in favor of acting earlier, more softly, rather than waiting to act more dramatically. And saying, hey, this is what we're getting. Tell me why I shouldn't be unhappy with this, or tell me how you're going to make me happy with this or the improve. You know, that isn't acting hard. That's acting pretty soft. And so if we're going to act soft, I'm personally in favor of doing that sooner than later. I don't think we've seen a meaningful change to because this isn't all just COVID. Everything for the next 5 years is going to be excused by COVID. If the Lindbergh baby disappeared, it would be COVID. So let's look over a longer term and understand why that's happening and what they recommend we do about it.
Yeah, we can't have a fourth of our portfolio continuing to underperform benchmarks that they were involved in helping us set. That it's consistent for a long time. As we somewhat joked at our last meeting, you almost have to try to generate some of these numbers. Now, what I don't know is, and we should be prepared for their potential response. What if they say, either A, we recently changed some of the money managers, or we will change some of them? Does that give them a go directly to start free card, or what if they say we'll change internal staff? What will our position be? Will it be?
Go ahead. My personal thought would be, to John's point too, that we're bringing this up and it's of concern to us, and let them say what they would intend to do. And then I think we tell them, actions speak louder than words. And we review this. We see the numbers almost every month. We'll review quarterly, and that we will continue to make decisions for this portfolio I think we would say we've already taken step one if they weren't aware of that, which I think they are, where we did some consolidation. I think that we just lay it out that we will continue to evaluate the best approach to relationships with money managers and sort of say we will. I don't say we immediately say, and because of this, this is why we're pulling all the money from you. But yeah, we got to give them time to actually show us that what they decide to do is working. But let them know that we will be looking at this just like any other fund would do or any 401k plan would do and look at performance. And if they're not performing, then it doesn't look favorable for them or their bank when we look to make additional consolidations, if that's what we choose to do.
And I do think it would be prudent to indicate a time horizon. Personally, I feel like a time horizon is measured in months. It's more than weeks. Nobody can really make radical. We don't want them to make radical changes in weeks. But I also don't have a real interest in doing this more than a full year from now. I think if this is sort of the come to Jesus meeting, and if they're not willing to or able, I don't think it's a willing. I think it's if they aren't able to drive performance that is closer to benchmarks. We set a strike zone that was the size of a boat, and all we're hitting is the water. So yeah, I think they got to say what the strike zone would be. So personally, I'm thinking 90 days feels a little too aggressive. I think that because we operate within an IPS, because we have sort of an institutional approach to money, maybe 90 is not a reasonable time threshold. But I think 2 quarters, you can't generate some results that are more in keeping with what we're seeing in the balance of our funds. I don't know why we'd continue to give chances beyond 2 quarters. And maybe I'm open if people think 90 days is achievable, I'm open to that, but I'm just trying to be reasonable and rational and not motivate anybody to do anything rash or overly quickly.
Anybody disagree with that? I would be inclined to say we're going to continue to look at this on a quarterly basis, and we would expect we will look at it a quarter from now, but then also say, after two full quarters, we just want to let you know we are anticipating further evaluation of our portfolio management, and just sort of, I like telling them that 1 quarter I think is a little quick, but literally we expect to see something different within 2 quarters, or at that point we'll be back in front of you having the discussion again.
And I'm okay with it. Maybe this is too muscly, but I'm okay with in 2 quarters we're not having the discussion again. If 2 quarters there aren't materially improved results or results that are closer to our expectation, then I'm okay with I guess that'd be the 2nd quarter of 21. Taking a vote as a committee, and I guess it then has to go to the commissioners because we vote on recommendations, not on actions. But then I would be okay as a member of investment committee at least recommending that the commissioners move funds at that point. I don't want to have another quarter to review and decide. I think we sort of set in 180 days we have improved results or we have a different manager. It's not as this is the first time we've had that conversation. It's not as if we're not giving enough time. I think it's also not like we're not going to sell shares and move cash. We're going to move shares. It's not like we're taking a tax loss. It's not like there's mechanically difficult that way. So unless, Craig, from your perspective, that's really just picking up. I assume it would be one of our existing managers who would receive the funds we would pull. I don't imagine the reporting it's probably a little less difficult because you got one less moving part.
There really wouldn't be any change in reporting because even if we would down the road move the Bettman fund out of PNC, it would just go to another fund manager that we currently have, I would anticipate, and there would be no impact from our reporting. I think the 6 month does give them enough time to make the adjustments, then we can make a decision down the road. It'll be interesting to see what occurs because they are, as we go on to the next agenda item, they are one of our also one of our higher fees that we get charged. So.
Right, and that's where, we've talked about being sensitive as far as a relationship with PNC. We can, and John, I lean towards as well that at some point from a fiduciary standpoint, how many quarters, how many years has this continued the same type of performance? So I would be very comfortable as well saying that we will make decisions at the end of the second quarter. We can decide at that point in time if from a relationship standpoint, we want to keep the commissioners fund there. I don't know. That's something that, again, we've talked as a committee here that we've got to keep our fiduciary hats on when it comes to our investments. And that's why, and quite honestly, that's why we will go out of our way to make it a nice approach, soft approach here with them. But at the end of the day, do what we need to do from a fiduciary standpoint with the money.
And I won't have a lot of appetite for hearing, well, this is a surprise. This comes out of nowhere. These are your numbers. You generated them. This didn't come out of nowhere. This came out of your sheet. So if you didn't pay attention to the reports.
And we've had them in front of us a number of times.
They won't be surprised, in front of us or not. They're looking at these numbers more often than we are.
I hope so.
We hope.
They know they've got a problem here. And I do agree. Although it wouldn't be unfair to say you got 90 days, but they could make some short-term maneuvers that make the numbers look better that are not in our long-term interests. So I'm with you guys that 6 months is probably the minimum that you give them here, but whether they act like it or not, they're not going to be surprised. They've got an issue either with their team or some of these managers behind the curtain.
Okay, well, we'll take it as an action item. And I'll circle back to you guys just to let you know steps that we'll take here. But I think we're all in agreement on steps to take.
So Jim, you're gonna reach out to, you have a relationship with Kay then?
Yeah,
Okay.
yeah.
That meeting will be worth just the theater, Jim.
Well, and that's where, quite honestly, guys, it's not going to be just me. And that's where, I don't know if one of you or I'd like, you guys send me an email or something if you'd be interested or need some chuckles or something, Steve, but let me know if you'd like to participate. I assume it'll be a Zoom call, but let me know if you want to participate in that.
Yeah, that would be safer. If it's via Zoom, that would be safer.
And again, I'm not going to do it by myself. Minimum, Craig will be with me.
Yes.
But if any of the rest of you want to, let me know. Okay, what else, Craig?
Okay, moving on to any questions over the performance report?
Well, I think we've hit on the big ones as far as the Ball and Gainer. We know, unfortunately, picking up steam there a little bit, and then performance of PNC. Anything else you guys see that? Okay.
Okay, the next one I was going to review, I know it was brought up in regards to the EIN numbers and the classification of the trust funds. So received the information. I did not send it out, but just going through so everybody's aware, and I can share the information. Let's take a look. I have to pull it up from. So when we look at our EIN numbers, and this is something that just go through the Bettman, and this came up, if you remember back in our last meeting, the Fleshman account that was at US Bank that does have its own EIN number is considered 501c3. We were informed that we did not distribute the full amount of income that was needed to be distributed, and we had to distribute it, or else we're going to get penalized by 30%. And it was only around $4,000. Wasn't a whole lot of money. But going through this exercise, was reached out by Fifth Third Bank during this time. And the same thing occurred with Fifth Third Bank and Jim can speak to this too, with the Hawk Fountain Square Fund and the Meyer Fund. Now, at Fifth Third Bank, Sudi Acres is already considered a 501c3 and already distributes a set amount every year. And Fifth Third Bank has now rolled Hawk, the Foundation Fund and Meyer Fund into that to where there will be a set distributions. And going back is all those have their own EIN numbers. The ones that have the city's EIN number is the Bettman account, the second Fleshman account, the Geyer Trust, and the Miles Edward. So those all have city EIN.
And Fleischman, is it the smaller of the two? That's
I'll let you know. Give me 1 second.
while you're looking that up, Craig, let me just frame it a little bit for everybody. It's something Kevin and I have been talking about is, I think, the legacy that we would like to leave with the park board for this committee is that we get things cleaned up and buttoned down. And we've made some real progress towards that, but we've got a ways to go. What has come up, as Craig mentioned, with our discussions with Fifth Third Bank is this whole, I don't know why it's happening, but either through audits or whatever, there's two different distinctions. These trusts can be either considered a public charity or they can be considered a private foundation. If it's a public charity, a tax return is filed each year for that trust, and taxes are paid, and Craig, correct me if I'm wrong, but taxes are paid on the earnings of those, on those trusts. If it's a private foundation, it's tax exempt, but there is a required minimum distribution of 5% from each of those trusts on an annual basis. What we have been notified from Fifth Third was that two of these funds that are in question have been switched over from a public charity to a private foundation, and distributions have not been made. So not only do we have to take a distribution this year, but a higher distribution, but there's a catch-up of distribution. So Craig, I thought I had my notes here, but we're talking a couple $100,000 just from one of the accounts, if I'm not mistaken, right?
Yes, it's $200,000 for the Meyer Trust, and then it's $140,000 for the Hawk Fountain Square.
So, and then on an annual basis, where we have been approaching this, as you all know, that annually we would sit here and say, do we want to do a 3% distribution from these trusts, or do we want to do a 5% distribution from this trust? And as you all know, this year we said, there's not a cash need immediately, let's just do a 3%. Well, on these that we heard from Fifth Third, we're going to be forced to take a 5% distribution or pay a 30% penalty if we don't. So one of the things that I want to do is, as Craig's starting to do, go back to each of our trusts and just get in writing how each one of these are classified, and perhaps get a trust attorney involved with us to look at these, because I think as we're getting into it, there seems to be a number of questions that keep coming up. Not the least of which I know something Kevin has continued to talk about is one of these trusts. The original documentation, the basic documentation we have, is just an excerpt from a individual's will that set up a remainder trust, from which there was a gift to the parks that Fifth Third Bank has deemed a trust, of which they will remain the trustee. So it's those sort of things where I would, and I'm throwing this out as a question just to get feedback from you guys. I would like to go to the solicitor's office, and because we have to go to them first, and just say, hey, here's what we're finding, and we need some help. And you need to point us to a trust attorney that can help us with some of these issues so that we can get it all straightened out.
Yeah, I would even say it's probably a tax attorney, Jim,
Okay,
that has some specialization related to nonprofits. Because they're going to know the best way to do it, the best way to handle it from there. And then however the best way is, to the extent we can, and this would be another question for the attorney, how can we make them all the same if we can?
yeah,
So that we're not saying, oh, we've got to file a return on this one, but we don't have to file a return on this one, but we've got to take a distribution on this one, but we don't have to take a distribution on this one. Just as we've tried to simplify by reducing the number of money managers, I think we want to simplify by, we treat these all as the same. So from a tax standpoint, we should want them all to be treated the same as well.
okay,
So somebody like Pat's Teller or somebody like that would be good.
yeah.
And forgive me, this may just be a nomenclature question, but it's private foundation or public trust. Were those the two categories?
Public charity. Is that correct, Steve?
Yeah, and they're both 501c3s.
Right.
Okay, so public charity, because what I go back to is at different points in my 20-year engagement with the parks, there have been questions around, oh, these funds, these endowments, these trusts, these monies, whatever we're talking about, there's been some contention that those were in fact public monies. But I'm thinking public is a homonym in this case. It doesn't mean we're not really leading with the idea that these could be directly City of Cincinnati funds, or are we?
I don't think so. I think we all, well, it just points out, I'm amazed that Craig has found that some of these have the city's tax ID number on them. Had I not heard that today, I would have all said, no, that can't possibly be. But,
So what do you think that really means? So two questions. Does any of the Fifth Third money have a City of Cincinnati EIN? And secondly, let's say just focus on the Bettman Fund, for example. Does that mean that it's really not a pure endowment potentially, that it's a quasi endowment that the city established and or the park board designated? Or what do you think that really means, Craig, the fact that it has a City of Cincinnati tax ID?
That's what I would like to really get individual in here and go through the actual document itself, the will itself, trust itself, because when you look at the Bettman, it is specific stating the income from the Bettman Trust to go towards the Explore Nature program, not educational programming, for the park board as well as the Bettman Preserve. So it is very, and I was shocked when I went through there that they all did, like so many had the city's EIN, and especially, I guess, especially with the Bettman, because when I go through that actual document, I don't know if at some point it was changed to the city's EIN, and I think that's where we definitely, I would support getting assistance around these to identify the best approach for these items for the trust funds.
And I imagine that's a substantial legal expense, tens upon tens of thousands of dollars. But if we have RMD requirements, there's probably some, I mean, it's obviously the commissioners determine where that comes from, but it would seem to be an appropriate use of that to ascertain with some certainty. Craig, like you, I tend to think sometime in the last 80 years, some trust officer at Fifth Third said, no, that's the city's EIN, and filled something in. I don't know that that's a purposeful, intentional, deliberate thing. I don't know that it isn't, but I hope that somebody who specializes in that tax or trust or tax and trust, or maybe it's a different partner in each or whatever, but I hope that they can reconstruct that in a way that then our successors can use going forward. And ideally, to the extent that it can be, I think if there can be buy-in, acceptance, I don't know procedurally how this happens, but if the solicitor can say, yeah, I like that, I agree with that, I think that would be a really good step to forestall future controversy around that.
And we could have a conversation with Andrew Garth, who's the acting city solicitor now, and is a very good guy. Worked very well with him when I was on council. But I think, I mean, and I was a philosophy major undergraduate and real estate attorney during my practice. I don't know anything about this shit, but I will say, because there are covenants like this in real estate deeds.
Mm-hmm.
And in my mind, there's no question that, for example, Bettman, where there's specific uses called for, there's no way that that should have a city tax ID number. That the city can't access that. We have to act at, Jim and I, as two of the commissioners, we are actually putting on a different hat with that as trustees of that trust. So, there's the potential for the city to say, well, it's got a city EIN number, it's the city's money. And then the park commissioners are back in a fight with the city again, and we don't want to go there. So that's why we need to get this fixed while we're all smiling and on the same page.
And that's what I'm hoping that the solicitor will, and I don't know if they're in the business of doing that, of kind of accepting an opinion and saying, no further action or something, but that'd be great if we could attempt to solidify that as best as we can.
Yeah, I think that we would be able to get once we figure out what we're supposed to do and get the buy-in, I think we would bring them as part of the discussions with the outside counsel. And, we're all going to buy it, whether it's a codicil to the memorandum of understanding or, First Amendment to the memorandum of understanding. The city signs off on it. Park commissioners sign off on it as park commissioners and as trustees of the trust. And if we have to have Fifth Third as trustees, Fifth Third signs off on it as well.
Yeah.
Well, then I think we're all in agreement. So we'll take that as another to do, that we'll get that ball rolling as far as discussion with the solicitor. We started some discussion about this with Christine, as you might recall, shortly after I came on the board. So, and it never went anywhere. But we'll rekindle this whole story, because I agree with Kevin. I think we just need to get it all nailed down.
And it sounds like what Craig has found out about Bettman is very consistent with Kevin's position and philosophy, we'll call it. But keep in mind, we may still find that, yeah, this is all clearly park board and really all pure endowment, not quasi. But we might find out that Fifth Third's interpretation that some of this is private foundation money and therefore subject to the RMD, it may still be an issue we have to deal with, which again, may not be the end of the world, but it means we'll have to take that distribution and then track it and park it someplace and spend it still according to the trust documents. But I think that's probably a more realistic risk than that we ever lose any of this.
And it could be, Steve, that we take that required minimum distribution from the ones we have to, and the ones that we don't have to take that, we don't take as much of a distribution or any distribution, so that the blended amount out is still the 3% benchmark that we're looking at.
Mr. Getz and I had a very identical conversation about that possibility. So.
Yeah, the only thing we threw in, the only mix there that screws that up a little bit is the restricted nature that if some of that money that we take, the 5%, can't be spent on things that need it. You know what I'm saying? But I think we do have the flexibility, and that's where it appears to me, I just want to get it all cleaned up and just be clear what it is. It appears to me, it just may be that we are starting to get more distribution than what we might have before, which then just puts the onus on us. Fortunately, Craig's already set up with PNC now, the investment account, so we can be earning some money on it, where in the past it was just sitting in a checking account. So I think the driver in all of this is that it's just pointing up that we just need to get it all cleaned up. And I think that's where we'll head with that. John, along that same line, from a Cincinnati Parks Foundation, do they have individual endowments as well? I know they've got what they've said to us as buckets of money, that there's gifts that have been given that sit and must be spent on certain things in the park. Do you know, are those true trust documents that they've set up, or
I would not say true trust documents, and I'd say that has evolved a little bit. And bear in mind, this is 2 years post my direct involvement, but at the time that I had direct knowledge of it, it was, there were a few, maybe 3 different categories. One were completely unrestricted. Use this for the benefit of the parks. Great. And then that was sort of one bookend. The other bookend was, you're going to use this for playground equipment in Alt Park, and you're going to sort of reserve from it, and every 20 years you're going to buy new playground equipment, or something to that effect. And then there were some, and we did an enormous amount of work with this Don Malott, who I guess is becoming president soon.
He's now president, yeah.
Don, God love him. I would hate to have seen the bill if we were paying for it, because he did an enormous amount of work sort of determining if the available funds exceed the practical need for the work. There is a procedure you can go through, or if they've outlived the need, you can go through a procedure at the Attorney General to get funds unrestricted. So I don't believe the word trust was ever used, at least as of a couple of years ago. There were restricted funds, and there were sort of partially restricted funds, and then we were working to set a class of, we need to raise X money for this. And if we've raised more than that, we can use your contribution. As long as we've gotten this thing done, if we had extra money, then we can put that towards something else for the general benefit of parks. And that had to be disclosed in, I think, actually solicitation letters. It wasn't good enough to just do it in acknowledgements. I don't recall specifically there, but the short answer to the short question is I don't think there were any EIN questions. It was all around restriction of funds, not separate entities, for lack of a better word.
Gotcha. Good.
John is correct there, because I've seen that wherever there's a pledge of money towards Parks Foundation, they do have that where the donor has to sign off that the funds can be used for other purposes if that intent was already purchased or purchased.
Guys, we did that exact thing at Chatfield within the last year. And Montag helped us through that. But we reached out to the Heekins about some leftover money, and that we had expended it for the restricted purpose, took care of everything we were obligated to do. So then it became either unrestricted or quasi, which is the same.
Great. Well, I think maybe in this whole process of cleaning things up, we may run into something like that. And I know an example for us personally, or with the park board, is Geyer Fund. That initially the Geyer Fund was set up to only benefit the Geyer Esplanade or the Oakley Square Park. And because that money kept building and building and building, we couldn't possibly spend that much money on that little esplanade. You can petition and go through probate court and get that. So we had to go back, and we found heirs that were still around from the Geyer Fund, and there was no objection, and it was recertified through a judge's order that as long as the funds were first used to maintain the Geyer Esplanade, any additional funds then can be used for a similar purpose in any of the Cincinnati parks. So it may be, as we get into this, we'll take a look at that, but it may be if there's a real old fund that is building up and has a restricted use, we'll discuss it at that point in time, but maybe look for an opportunity for the same approach.
Great.
Okay, Craig, we'll move
I do
on.
want to follow back up. So the one that has a city EIN, the Fleshman, that is the largest of the two.
Of
It is
course.
it's the 2.6 million versus the 867,000.
Thank you.
I apologize, Jim. I have a 4:45 call, so in a few minutes I'll need to drop off. Are there any other vote required things though? Because I don't want to mess up anything.
I don't think so. No, there are no vote requirements. I think the next thing that Craig was going to go into was fees, a review of the fees. But no, John, when you need to pop off, go ahead. And then Craig, if I would ask you while John's still on here, after you get the minutes, go ahead and distribute those before waiting till the next meeting to distribute, if you know what I mean. So
Yes.
I would distribute those minutes as soon as you get them pulled together, just in case something comes up like after John leaves.
Yes, I can do that.
Super. Okay, Craig, it's all yours.
And then I know one of the follow-up items that wasn't on the agenda, the Fleshman accounts, why there's two. It was two separate donations. I'm still looking into which one belongs to which, but there was two separate donations. One was made by the Fleshman family in 1926. And then the other one was made by the Fleshman, not the actual original, but it appears the grandchildren and children of the Fleshman made another donation in 1946, 48. And it couldn't be combined because the original one was a trust. So that was a follow-up from there. And my assumption is the 767 is the original, since it has its own EIN. And then the new one, the 2.6 million, is maybe from the children then. But we'll find out later. Going through the fees, we'll move on to the fees. If you look at that, no surprise, we knew the PNC Bank fees are the second highest. The highest is and we learned that through our last meeting was Fifth Third. They do have the highest fees. Then around 0.92%, 92 basis point. Then you have the PNC, which averages out to 0.86% or 86 basis points. Then looking at the US Bank, and this their total is 0.47%. Then Miles Edwards is 0.52%. And I plugged them in based on an average fund balance, so you can get an idea of what that percentage and what those total dollar figures are.
And Craig, so like with Fifth Third Bank, you get this data broken out by fund. It's not one fee that you've allocated.
This was broken out. I'll have to go back in there. I believe it was by fund.
Okay. Because I was assuming that Fifth Third's fees might be higher because they are the trustee on most of those. I think they're the trustee on all of them, but the little levy.
Yeah, let me research that, Jim, and get back with you to make sure I just didn't look at it as an aggregate.
Okay. Yeah, take a look at that because it may be, and before we discuss with Kay, I would just like to understand if there's an additional fee that we pay PNC because they are the trustee.
PNC is not the trustee.
Third.
Oh, I'm sorry. I
referring to
mean,
Fifth
no,
Third.
you're absolutely right. That's duh.
But you're, Craig, when you look at the advisory fee, that's what you see coming out of the monthly or quarterly statements. And then is the fund level the money manager fee? And you don't really see that, but did they have to tell you what those fees were?
Yeah, they provided a fee schedule, and on some of them, yeah, indicated what those fees were.
So, you know, that if that's the case with the Fifth Third money, to end up at almost a point, you know, these are our Fifth Third funds, and we're still paying 33 basis points behind the curtain. And, you know, you're certainly not getting the type of return with PNC and Fifth Third to justify paying any more than what you're paying US Bank and Ball and Gainer.
I think this would be another part of the question that tax/trust attorney would be answering would be, what rights might we have to attack those funds and tell Fifth Third, no, you're not the trustee. Park commissioners are going to be the trustee, or, you know, the Park Foundation is going to be the trustee, or somebody else is going to be the trustee, because then, you know, right now we don't really have an option to say anything to Fifth Third that their fees are too high, because all we are is the beneficiary, supposedly.
Yeah.
Mhm.
Yeah, no, you're absolutely right, Kevin. Oh, well, this is good information, Craig. Thanks for pulling this together. And to Kevin's point, we'll also use this as we're hopefully dealing with, working with an attorney on this.
Then the last thing I had on the agenda was discussion of outstanding items and parks projects. Jim?
One question I had for you, though, you had sent us a schedule that was special trust funds.
Oh, thank you for reminding me. Let me go ahead and. Yeah, I received that late yesterday from Sam from downtown.
So help me understand this. So are we, well, I think this is just another one that we got to get into, because are we the beneficial owner of all of these? Because when you look at the market value, it's significantly higher than what we have in available funds, I guess. Because I think what I'm seeing is that like on the Groesbeck Fund, there's $57,000 sitting in available, so to speak, actual cash. But then the principal, the corpus on the books is what the cost number is, but the market value is significantly higher. I don't know. I just would like
Who
to get,
provided this to you, Craig? Was this the treasurer?
It was Sam Stevens, yes. And of the requests, I sent the request to Nicole a couple months ago. I've been following up. Then he sent this over late yesterday, and I haven't really got any time to dive. I haven't had any time to dive into it yet to ask questions back. But because this was all brought up, if you recall, the ship lap donation was around $100,000 back in like 1892. So my question was, well, why hasn't it grown in value? But this is kind of coming off this, and this is what they shared yesterday.
yeah, I think we obviously need some more information on this because like, yeah, I'm not sure what this is telling us.
And yeah, even with
Yeah,
the
I think,
interest-
Jim, you started off the conversation with saying, you know, we've got this money sitting in these restricted accounts, but it never changes.
Right.
You know, unless we take a decision, it never goes up. So obviously they are investing because they've got something called the city treasurer pooled investment account. You know, where is that interest going if it's not going to the restricted funds? And the other interesting part is this only shows what, 4 different funds. And, you know, we've got millions of dollars sitting in other restricted accounts.
Yeah, I think those were pretty evident, and Craig does get, I think you get on an annual basis, we do get earnings on our park restricted funds, correct? Like
yes,
329 and all that. Don't we get at the end of the year a piece of earnings on those?
yes, we do.
Yeah, I think this question came up, Kevin, exactly as you said, where every year we just see 50-some thousand dollars sitting there and it didn't seem to move at all. And as Craig said, like with Schmidlap, it was initially $100,000. And now you look at this and say, what happened to it? Was Duke shares down that much from when it was originally given to us, or what's happened? But I think we'll just need to get more information, Craig, if you can go back and just understand it a little bit more. Yeah. So yeah, we'll just keep that as an open item. You can bring us up to date on that next time.
Well, you know, Jim, but thinking back to some of the restricted accounts that we have, I'm not talking about the huge capital account, but let's take the boat dock. Assuming that we have that state money in our account, that $1.5 million, it still shows $1.5 million. It doesn't, you know, if it's been there since 2016, it certainly should have had some earnings in the last 4 years.
Well, I think that's a good question, Kevin. I hadn't thought. Capital, I don't think they allocate earned interest on capital accounts. But I know
I can see if it's a city capital account where there's city dollars that just haven't been spent yet.
yeah, you're right.
But I'm saying this is outside money.
Yeah.
So if the
Yeah.
cities receive that money, the treasurer shouldn't be swooping those earnings. That should be going to that restricted account.
Kevin, I think you ought to bring that up. I think you ought to. No, I agree with you. And Craig, maybe you could just ask the question of Treasury or somebody. I think we all know that on our park restricted funds like 318, 329, whatever those all are, I think I recall seeing some allocation back to those accounts on an annual basis of some earnings on those. But you might ask the question on these capital accounts if that's handled the same way or not. And to Kevin's point, was money that parks received from federal government through the state or the state through, I don't know where it came from, the ODNR
It
money,
could
I
be
guess.
state, it could be Western Southern with the Lidl.
Right.
Park, all
Yeah,
those-
exactly. You might ask Matt, whoever that person would be, ask them about those accounts, capital accounts.
Yeah, I'd start with Karen, I think. Karen Alder.
Cool. So if it's up to me, Steve, might I suggest that maybe we just grab a beer or lunch sometime and I can just bring you up to date on any open items at the parks projects and that sort of thing. Kevin's well aware of what's going on at the parks, as is Craig. And since
Yep.
John's logged off, we'll save everybody some time here and I'll buy you a beer.
Deal.
All
I
right.
vote yes on that too.
I'm still waiting for some of that bourbon, Kevin. You know, you teased us with the bottle the other day.
That bottle will stay unopened. That's my Daryl Gordon.
You know, I'll digress here just a second. When I retired from DJJ, I was given a commemorative bottle like that from Woodbridge, because Woodbridge is my favorite. And they had the bottle engraved and everything. Well, that lasted maybe a year into retirement. Now I think I saved the bottle, but the contents thereof is gone.
That's funny.
That's the right approach.
Exactly. Anything else you got for us, Craig?
No, I do not.
Do we have a next meeting established, or should we look at that?
Yes, let's take a look at that. How I do know, speaking with Terry reached out from PNC, he does want to present during the next meeting if that's possible. I don't know how that's gonna play out with reaching out with Kay.
Maybe we put him off one meeting.
Okay, that's what I was thinking that, and just want to make sure you're all aware. He did reach out, and that was wondering if he could present then.
You know, I would, this meeting ran sort of long. Let's let the next meeting, let's save some time there, and we'll in the meantime have a meeting with Kay, and then at the next meeting, I hope we've made some progress in getting an attorney involved. At that next meeting, I hope we have some discussion that I would like to bring up with this committee regarding the Bicentennial Commons trusts that the park board are the beneficiaries of. Perhaps have that as an agenda item, but let's push PNC to the following meeting.
That sounds good.
So this is October. Why don't we shoot for early December? I don't want to go, obviously, except I don't think anybody's going anywhere for Christmas this year anyway, but why don't we look at is in the first half of December.
Yeah, I was looking at potentially the 9th, if that's open for individuals. We tend to always have our meetings on a Wednesday.
Steve, you're the one, I don't want to hit the same week that you usually are bombarded, so look at your calendar.
Yeah, weirdly, the 9th is wide open. I think I'm going to do the finance committee here, Jim, the previous week. So
Okay.
Wednesday, the 9th is okay.
Kevin, how does that look for you?
I'm weirdly wide open on the 9th right now as well.
Well, let's take weirdly and let's book it, Dano.
Deal. 3
Same
o'clock.
time, 3 to 5.
Yeah, let's do 3 again.
Okay, with no presentation, so we have time to discuss how the conversation with Kay went.
Super.
And Jim, maybe you and I can get together in the next week and call Andrew and see if we can, get that conversation started.
Yeah. Yeah, let me follow up with you, Kevin, because there's a couple of conversations like that I think we can maybe bring up at the same time.
Maybe have some bullet points so that we make sure we get it all at once.
Okay. I'll follow up with you on that and try and get it. This is Wednesday, so let's shoot for early next week, but I'll touch base with you before that time.
Sounds good.
And Steve, we'll coordinate calendars.
I'll be around. I'm not going anywhere.
All right. Craig, thank you for the legwork and for pulling this all together for us.
Here, here. Good meeting.
Thank you all for joining, and have Steve, if I don't speak to you by Thanksgiving, I know Jim and Kevin, I'll be speaking to you before Thanksgiving. Have a good Thanksgiving.
You do the same.
All right. Thanks.
Everybody. See you guys.
Thanks, Mary. Get rid of us.
Thanks, everybody.